The biggest things that we have done is we've stuck to the strategy. So you have to be consistent, right? Because the market is anyway fluctuating. If you also fluctuate with it, then you'll go for a ride. If you put money into some random aquaculture IPO right now, and I'm just giving a random example, versus let's say a power or a semiconductor IPO, there's a world of difference in terms of how both the IPOs will react, how they will pop, and how they will do after that, right? So I think the basics don't change, but building this capability to identify themes and making your investing more thematic can really turbocharge your return.
Hi everyone. We are here with Mr. Prabhakar Kudva, who is the fund manager for Samvitti Capital. We have started this new series, Capital Conversations, where we talk to fund managers and listen to them, their story, and understand from them how they have brought up the fund, how are they looking at markets, etc. Again, this is a super informal series, so we'll not be editing it, etc. as much. We'll just put it out as how we feel that we are able to bring the journey out of fund managers. Prabhakar ji, welcome to the show.
Thank you so much, Manish. Pleasure to talk to you.
So let me just set up the context for the show per se. So in terms of my viewers, usually we have this YouTube channel by the name Sunday Investing, wherein any IP, and again, like we are people who had a corporate job till a long period of time, right? So Monday to Friday we used to say we used to do our corporate work, etc. And then Sundays when we used to look at markets, and we were very passionate about primary markets. So we used to do this on Sunday, wherein we'll come in and we'll talk about all the IPOs which were coming in next week from a fundamentals perspective, that what do we see about the company, what do we feel about the company. That's how they started, and then we pivoted into know your promoter. That is what you see my background as well, wherein we now interview promoters when they are coming in with their IPOs, etc., and understand from them their vision. And now we also wanted to do this series called Capital Conversations, which you are the first guest of, wherein we just want to understand from fund managers, etc., as well, how their journey has been. So in terms of most of our viewers would be IPO investors who know the market and understand the market, but like IPOs, most of people usually flip, right? Like they are, in a way, I joke this, that they are debt fund, they are owning a debt fund wherein their risk is only from day one to day three, which is the listing day, and then listing day, whatever pop they get, they take out and then they keep churning. But a lot of people also want to invest for longest period of times, but it's just that there are so many companies, so many listed companies, etc. So some of the answers, if they could be tweaked to like how do you feel they can invest, or probably to IPO investors, etc., that would be helpful during the show.
Sure, sure. I mean, so if I see, because I am mostly a secondary market investor, right? So my thought process and my thinking also will be more aligned to that. So you can nudge me, in the right direction wherever you feel that there is something we can talk about from IPO point of view. But my straightforward thought process will always go towards secondary markets
No,
because
that's great, sir. We
that's
also want to listen and pick up secondary markets per se, so it's good to just to talk to you and about that.
sure, sure, Manish.
Yeah, maybe to start with, we'll just start with your background. If you could just talk to me, because I was seeing you're based out of Mangalore. How was life growing up in Mangalore? And you don't have a traditional experience of, let's say, a CA, CFA, something like that. You were a computer science engineer. So why did you decide to get into investing? How was your story like?
Yeah, I think personally for me, so I was fairly good at studies. So you usually either in India, right, you move towards engineering or towards medicine, right? I mean, at least at our time. I think things are changing now, but I actually grew up in Delhi. Not so much here. My dad was a banker, so we were moving across India, and a large part of my schooling happened in Delhi. So for my vacations, we used to come back to Karnataka to my maternal uncle's place, and he was a big time market enthusiast, right? So during our vacations, I used to sit with him, and he used to teach me, how to read charts. He was a technical, more technical focused, right? Even today, he does technical analysis. So that is how I started, learning about markets. And I think I was about 15, 16 then. And the bug kind of bit me, right? And and also, right, all the qualities that you need to be good at markets, right? Analytical skills, a lot of reading, a lot of thinking. So inherently, I felt that I enjoyed all of those things, right? So uh, So very quickly, I realized that this is something which fits with my personality, number one. Number two, I realized that this is, you versus the market, right? There is no third party here, right? So you can do this alone, right? Tomorrow, if nothing is there, individually, I can operate and, I can make a living and I can enjoy, doing it. And it's a very, very intellectually stimulating exercise, right? Because the best of the brains, are out there, right? If you look at the hedge funds, if you look at the US, India, the best of the brains are employed, in the stock markets one way or the other, right? So intellectually also it's very stimulating to be able to read, analyze, assign probabilities, bet, and see the outcome. So the whole game is so fascinating that I've been lucky that very early I realized that the depth of it I'm realizing it only now, right, over the last 5-10 years. But at least the gist of it I got very early that this is something I like doing. But still, there is no stock market degree, right, anywhere, right? You can do an MBA, but MBA is a very generic degree, right? So you can't really work your way into, directly into a stock market firm, right? So, like I said, I was fairly good in studies. So I got into engineering. I got a fairly good, rank at the entrance. I got into engineering. So I studied computer science, but this bug was always behind me. Even in college, my seniors, the people I used to talk to were people who were interested in markets. And then I started, once I got out of college, started earning money. I started helping out family, friends, relatives in an informal manner. So I was moonlighting, like just like you said, some like how you started or some of your partners started, right? So it was a Sunday investing kind of a thing for me also, right? It was that I was working, but also reading about markets, managing money informally, although from a regulatory point of view, but it was a small money and it was family and friends, people who trusted me, and I did extremely well for them. Partly it was bull markets, and partly it was things I learned. So that is how the journey started, and I was then, because of my interest in the markets, right? My cousin, who is also, my co-founder now, right? Atul, he was running a firm called Omnisys, right? And he was one of the co-founders of Omnisys, and Omnisys built technology for capital markets, right? So even today, the backend that Zerodha uses, or a Grow uses, or a Motilal uses, was built by Omnisys. So because I was interested in the markets, he said, "Why don't you come and work with us?" Although it was a tech firm, and I was an engineer. So I joined him as a product head, and I was managing, I was helping out these brokers, with their execution algos and all of that, and different things. So I understood the markets and I understood technology, so I was like the bridge. And then I think that company was sold to Thomson Reuters in 2015. And then Atul suggested that, now that we've sold the company, why don't we start something on our own? And since I was very interested in markets and I was carrying that interest all through. And I was doing well. For me, Atul and another person, Shivram, who's a chartered accountant and a family friend, and somebody who's been in the market since the 80s, right? So he's seen all the cycles, right, from Harshad Mehta all the way to the most recent cycle. So the three of us came together, and we started Samvitti in 2015. And just like you, we started with a base of about 40 crores from family and friends. And over the last 10 years, we've grown this to close to 2,000 crores. Primarily, I mean, without any marketing, without any shouting or no distribution, nothing, purely on word of mouth and sustained performance over a period of time. So that's where we are right now.
Understood. No, yeah, that's helpful. So when you started in 2005, how was investing like? Because right now it's a lot more easier, right? You open screener, you go and you get all the information at one place, right? How was investing like, and how have you seen that evolve over the last 20 years per se?
Uh, I think number one, the amount of knowledge that is available right now, right? Whether it is YouTube, whether it is podcasts like the one we are doing, the amount of information for somebody who wants to learn is humongous. There are so many practitioners who continuously come and talk about it. At that point in time, there was hardly any information, right? Most of the information was available through books, and these books were mostly the same old, Warren Buffett, Charlie Munger, Peter Lynch, which is a good thing and a bad thing both, right? Because the good thing, because you kind of got very structured and focused information, from where you could learn and implement it. Now, in a way, you get a lot of information, but also you have to deal with the information overload, and you can't differentiate between who's a good influencer and who is a bad influencer, and so you don't know all that, right? For a naive person, for a new person, right? So one difference is in terms of the information available. The second difference, obviously, is the communities, right? There were hardly any investor communities, right? So I think back then, if I remember, there was something called as the equity desk, and I think Value Picker is still going on right now. But there was Value Picker, just one or two communities where there was a money control message board. So there were these two, three things where people used to come and discuss, right? But now, on Twitter, 24/7, you can get commentary by like-minded people, by very smart people. So the information, availability was one big difference. Other than that, just the speed of how the information is discounted, right? Earlier, things used to take slightly a little bit more time, right? But now things are discounted instantaneously, right? So somebody like us, right? We're sitting not even in Mangalore. We're sitting in a place called Mulki, which is like a small town, between Mangalore and Udupi, right? And sitting here, I get access to information via, the news wires of what is happening in, let's say in Iran or US, at the same time as somebody in Mumbai, which is what is allowing somebody like us to operate, right? So the penetration of technology, penetration of broadband, all of that has significantly improved. Like you are sitting in Bhopal right now, right? And you're managing the show from there. All these things were a bit unthinkable, in 2005, 6, 2010, right? You had to be in Mumbai. So Mumbai had an edge. Now Mumbai no longer has an edge, right? So Mumbai had an information edge, right? That edge now, for all practical purposes, is gone, right? So I think these were a few differences, but the basics and the foundations don't change. Somebody who was a good investor in 2005, even today is a good investor, and somebody who was struggling and trading and doing all sorts of things then, even today, if they have not meant their ways, they're still losing money. So the foundations have not changed. Just the environment in which we operate has changed in some ways.
Understood. Good segue into the next question. You said that Bombay had an edge. So, what made you decide to not move to, let's say, Bombay, work with the established fund house, etc., and then take the plunge? How were the initial years like? What was the hardest period that you went through? Because I'm sure when you were just starting, there would be challenges, etc., which you will face, right? So, how was that journey like?
Yeah, I think Bombay was never even a part of the discussion, right? We are from here, and this is our native place, and this is where we wanted to start. So it was very clear. So we see our idea was not to do this to be successful, right? The idea was to do this because we love it. And like I said, we started with 20-25 crores. We never planned that we will get to 1,000 crores or 2,000 crores, or even today we don't have any plans that tomorrow we will get to 5,000 or 10,000. We don't have any targets. We don't have any. So we enjoy the game, and we like operating with the market. We like learning about the market. We like playing the cycles, and we enjoy both the good as well as the bad times as individuals. So there was no question of going to Bombay, working for some other fund, trying to be successful. So we did not have all those needs or restrictions, right? Which in a way has been a massive help, because this kind of a thought process allows you to think very independently, and to run portfolios which are very, very differentiated, to do things your way, to do things which sit with your personality, with what you're comfortable, and not try to do things to fit some narrative, right? So in that sense, Bombay was never really a part of the equation for us. We always wanted to start here. For the good or the bad, we were happy with both the outcomes. In terms of difficulties, I think, see, when you start a company, right? See, we are entrepreneurs, right? So you're not only the fund manager, you have to manage everything, right? You have to manage the compliance, you have to manage the ops, you have to manage the hiring, you have to set the processes, you have to build the team. So all of those things is something which we had previous experiences with Omnisys. So all of those things were, something which we knew how to do, which really helped us. we were very good at technology, especially for capital markets, right? So even that part, right? So we knew, in a way, we knew more than the brokers did in terms of, because we kind of ran their systems, right? Literally, we ran their systems. So we knew what it takes, how to build the technology. We built a lot of internal tools, to help us. We are very data driven, in terms of our analysis and all that. So difficulties were, just the usual difficulties that you have in any business. Difficulties in terms of, market cycles. Also, we mitigated because, like I said, right, we never chase, we never push. In fact, a lot of our investors or prospects get upset because we tell them a lot of negatives about market, and we kind of scare them before they, come in onboard them. We tell them what can go wrong, and so that has really helped us. Whether it was COVID, whether it was demonetization, whether it was the recent crisis, people have seen that if they've stuck around with us, and over the long term, they have made very good returns. Although the kind of strategies we run, right, the drawdowns are slightly more because we are more focused on the mid and small cap segment. We can talk about that later, but we never had any heart ache because of investor. Investor quality is very good by design, right? So we've had very good relationships with our investors, even those who have left us, right? And we have had investors who've left us and come back. We've had those cases also. Because upfront we are very clear that market is a different game, right? If you understand the cycles, if you understand the lumpiness of the returns, only then you should come. Right? This is not a game where every year you compare your return with an FD, or every year you compare a return with a particular mutual fund and say that this year they have done better, you have not done better. So we have all of those checklists in place, right? Before onboarding, we educate them and we onboard them. So there have been no difficulties, touch wood, except the usual, like I said, compliance has been a big, has been a big challenge, which we have successfully navigated, because compliance has increased seriously in the last 2 years, right? For the good, for the good of everybody, for the good of industry. But but a small house, right? It's very difficult now to follow because there are new rules around cybersecurity. A lot of new things are coming out. There's something called as a disability circular, a cybersecurity circular. So a lot of things you have to put in place, which over the long term is good. But now you need to have a dedicated compliance team. So all those things have been learnings. All those things, have helped us become a better, a more, confident fund house than what we were 5 years back. So the regulator has also done a great job. So all in all, I think no complaints. I would say, it's been a fairly rewarding and a happy journey so far.
I can definitely like align with you on the compliance part. Like yesterday, I was writing a compliance officer exam. Now NISM Series 3C is what you have to write if you are the compliance officer. So I had given that exam yesterday, so I can relate to it. But yeah, going back, you mentioned that being out of Bombay helped you in order to just not confirm with everybody. And I was reading Nicholas Davos's book where he also mentioned that while he was on his dance tours, etc., he was able to generate higher alphas because he will only look at the closing price and the opening price and not
Sure.
really get biased by everyone's thinking. But when he moved to New York, that's when he had his ruin because he was just following everyone's tips and just getting biased because human mind works like unconsciously we get biased, right? So it kind of helps. Would you say that it kind of helped being out of Bombay that you would not you would be able to form your own thinking per se during the process?
Yeah, no, 100%, 100%. I think, see, the whole game of markets is not about fundamentals, technicals. It is mostly it's a mental game. It's a mind game. I think as you navigate the levels of understanding the markets, finally you come to that conclusion that all of those things are there, but they are like just, table stakes. The real, alpha comes the day you understand that it is a game of psychology. It's a game of cycles. It's a game where how you position yourself, right, psychologically, and how you allow yourself to succeed, right? Because a lot of times, if you look at how people fail in the market, right, whether it is, taking leverage or doing excessive tradings, all of these are problems of the mind. All of these are problems of, if you're levered, like, right, and some, unknown event happens, then you're forced to take a decision. right? So the whole game is about getting into a position of comfort, right? Everything else is secondary. Stock picking, fundamentals, technicals, everything else, you can manage if you get this piece right. So I think sitting here away from the noise, away from the conferences, away from the management discuss. We don't meet any managements. We only read the con calls. We only see the results, right? Being away from that circle, I mean, that is a way of investing. I'm not against that. There are people who have done exceptionally well, even better than us, maybe, doing what they do. But for us, you see, we have to play to our strengths, right? Sitting here, I cannot act like somebody who's sitting in Mumbai, and somebody sitting in Mumbai cannot act like how. So we have to play to our strengths. Our strength has been, this kind of a, detached kind of an investing, staying away and investing. That has worked very well for us. And, I would say if somebody has a choice between Mumbai and in a place like, Mangalore or even Bhopal for that matter, any of these smaller towns, I think it'll be a nice experiment for them to, spend a couple of years in these smaller places and just like Darwas, see if they get an extra alpha, right? So a tier two alpha is something which you can call it.
Usually, I would have thought of tier two discount, but tier two alpha is a good word. I'll kind of
Yeah,
use
yeah,
that.
yeah,
But
yeah.
yeah, I remember during my education, I have done my MBA from Indian School of Business, ISB Hyderabad. So 6 months is when you get graduated, right? And after that, you have 6 months to yourself. The whole 6 months, we had a pack of friends who used to play poker all the time, and I feel that has helped me a lot in investing simply because poker is also in a way. I now not play it anymore. I don't enjoy it also because I feel it's local maxima versus a global minima would also be better than local maxima. But it used to be a lot of fun because the psychology remained the same. Like if it's not your day, just sit out, keep grinding. There will be times, etc. So that has taught me a lot. So I could relate to you when you mentioned that it's a long game. You don't really need to win every hand, or you just need to sit patiently, and there will be times where you will get that return per se.
Yeah, markets are poker on steroids, right? Because there are so many more variables out there. In poker, you have just those cards, right? Mathematically, you can actually play the probabilities and win. But here, this goes outside the bounds of mathematics, right? From a practical point of view, because the variables are so many, right? And then you have characters like Trump into the play, you know. So this is poker on steroids for us.
Yeah, yeah, for sure. Maybe now moving forward to the next section, if we could just talk to you a bit about your investment strategy. Maybe to start with, since most of us are IPO investors, do you usually look at primary markets at all, or do you want to have some secondary markets? It's important because if you're not meeting the management, then there's only so much you can know before the company gets listed. So do you only look at secondary, or do you also look at primary? And there are a few primary opportunities which can become multi-baggers, and usually at the time of IPOs you can get good stakes in them because otherwise building positions is difficult. So do you not miss building those positions, etc.? How do you look at that?
See, IPOs, partly this answers one of the earlier questions you asked, in terms of what's different between 2005 and now, right? So one of the major differences is in the IPO market, right? So the IPO market was much more retail friendly then because a lot of companies genuinely used to come to the market at fairly cheap valuations. But now a lot of those bigger quality companies, are eaten up by the private equity guys, and they come very late into the market. So even if you look at what's happening to SpaceX, right? It's already the fourth or fifth largest company in the world, right? In the US or in the world, right? So a lot of the alpha that was possible, 20 years back in IPO, it has now, gone down, broadly speaking, which is why probably the game has shifted to the lower rung of the market, which is let's say the SME IPOs or the small cap or the micro cap IPOs, where the private equity penetration may not be as much, right, compared to the slightly, because these guys, I think, typically enter once the companies has certain scale, your series A, B, C, and all that, right? So I think that is why the game, which earlier was available, even you could get a very good large cap or mid cap, not large cap, maybe a mid cap, a quality mid cap. So I still remember companies like Page Industries, which where we made a lot of money. It IPO'd a consumer franchise with some sort of an MNC, brand. It IPO'd at around 20-25 times, right? Which is unthinkable right now. First of all, it won't be allowed to IPO at so early at such a low market cap. So the market caps also would have gone up. But now I think, yeah, like you said, that story has probably shifted down the market cap curve, and which is where you are rightly operating. Number one. Number two, I would say that even today, right, IPOs in bull markets and IPOs in bear markets have to be differentiated. Right, so IPOs in bear markets can be very good bets because in bear markets, like the period now, where general interest of the public at large will not be there, so the speculation or the frothiness will be relatively less. So a lot of IPOs that come during the bad market phases tend to do. I think the hit rate will be much more if you evaluate them 2-3 years down the line. But one has to be a bit careful when the market is very hot, and that is when maximum number of IPOs will come, right? And that's so at that point in time, one has to be a little bit more discerning, right? So personally, we do look at all IPOs, although we don't look at SME per se. We look at all IPOs on the main board. We analyze them, but we don't try to play the QIP or that pop game, right? Because the good ones you don't get and the bad ones you don't want, right? So right, so and we don't, I mean, we don't do the anchor business also, right? So we don't get into the anchor, and because like you said, that needs a relationship building, and that's a different game which we are not equipped to play. So we very consciously look at IPOs because IPOs can be great opportunities. They are very new to the markets, and a lot of times they are under-owned, right? So structurally, if the company is good, then there is a good potential that institutional accumulation will happen, which can give rise to very large trends, right? So we do watch it, and but we give it a couple of quarters. We give it a couple of quarters of earnings, at least one quarter of earnings, 2 quarters of earnings, depending upon the company, the sector, the management. And post that first quarter of earning or second quarter of earning, if you see something interesting, we would love to participate in IPOs because they happen to give you the biggest bang for the buck. Number one, because I said because of under ownership, and number two, because of relatively low float that they have, right? So, for especially for smaller players like us, that becomes a source of edge, right? If you can get a very good strong fundamental combined with a low float, you can get some very explosive moves.
Yeah, for sure. That's something which we have seen. But like you said, IPO, we feel stands for it's probably overpriced, IPO. Because simply because it's one-way pricing, right? Like market is two-way pricing versus this would probably come when the timing is the best. So you always have to be very careful. But what I'll tell you, what has worked probably in the last a couple of years has been just the sheer speed. The regulator has done a lot of good things in terms of how companies come in public, because I'm sure you would know that earlier you would put in the application and then 15 days down the line is when you will get allotment, and then a week down the line is when the company will get listed. And that was also a good period, like 3 weeks to listing was brilliant. But right now you look at it, Wednesday when you apply to the IPO, Thursdays when or Tuesdays when you apply to the IPO, Wednesdays when you get allotment, Thursdays the share gets credited in your account, Friday the company is listed. So you can just
Churn.
churning a lot more faster, which
Absolutely.
again is not probably like it's horses for courses, so people tend to do different things, but it has just became a lot more better compared to earlier where your money would be stuck in for a longish period of time, so it would not make sense per se. So that's what we have seen. And again, like you said, because ownership can be less at around time of IPOs, it tends to work well. But like you said, you give it a couple of quarters of history just to see how that is building, which probably is not something which a lot of people are willing to do in the market simply because of FOMO. People think that it will just like if they miss it, they'll just miss it.
No, I think it's very important to. This is something I keep talking about on X also and in my blogs also, that we have to be clear about our strategy, right? So somebody who is playing a pop versus somebody who's trying to hold a company for a few years, right? They have to completely look at different factors, different variables, right? Because I want to hold it for a few years, I'm okay to, I wait for a couple of quarters of earnings. But somebody who's looking for a pop will have completely different variables. Now, somebody who's looking for a pop cannot say that, he's going to analyze it the way I analyze it. So I think one of the mistakes that people do in general is they don't have clarity around what exactly is their strategy. They're randomly doing things. A lot of retail investors, that is the core problem, right? They are randomly buying and selling, so they don't really know what is the time frame they are operating on, what is the market cap they are operating on, what kind of an edge are they trying to exploit, so that thinking is not there behind the strategy, which is what leads to a lot of very basic mistakes, and then they get frustrated. So anybody playing it for a pop, it's a completely different way of thinking, different way of analyzing, because there is no question of earnings and all that, right? There is no question of valuation. All those things are irrelevant for this particular style of investing, right? Valuation, like you said, that okay, there is some arbitrage that you can play. There is some thought process behind it. That I'm going to take this valuation, and I think it will go to, 2, 3x of that, and and this is how much I'm going to allocate. And this is how much I can expect if I'm right, this is how much I can lose if I'm wrong. So a thought process has to be aligned with the strategy, which is generally not the case, right? So this is something that investors should really spend time thinking about, that what am I trying to do in the market? How am I trying to extract money from the market? And then position, their research accordingly.
Understood. Maybe a good segue into the next part per se. How is your thesis? How is your strategy? Like from what I know, you invest typically in companies where you feel there's a catalyst because of which earnings will grow very fast over the next 4 to 8 quarters, and then tend to hold them while they perform per se. But can you just walk us through what is the usual AUM that you invest in? What is the usual market cap that you invest in, and how do you identify these companies, etc.?
Yeah, so we generally have two schemes, right? So one is basically primarily into the, I would say primarily into small caps, but it would have some mid caps also. And the other scheme is primarily into mid caps, and it might have some large caps also, right? Now the reason for that is, the reason why we don't operate in a pure large cap space is because we feel that there is no value add that we can, bring in there. Number one, because I think if you want to play large caps, then the best vehicles is the mutual fund for you, right? There's so many both passive as well as active mutual funds. There is no value that a PMS manager can add to a pure large cap, a portfolio, right? Because you have a very small universe, and there is nothing much there, right? So that is why we operate primarily in the mid and small cap space. Number two, if you look at any research or data in terms of which particular segment gives you the highest returns over a 2, 3 year period, right? It is always the mid and small caps, obviously. So the alpha is there in the mid and small cap. And that is, so you want to operate where the alpha is there, right? So just for the heck of it, you should not operate. So you have to tell your investors very clearly, right? So what is the downside of mid and small caps? The downside is that the volatility is equally large, right? So if you are unable to manage the volatility, then mid and small caps is not for you. So the price that we are paying for that excess return, right, that you're getting over large cap, is the volatility, the drawdowns that you have to endure. So it is always the same risk reward equation, right? The more risk or the more volatility you're willing to bear, the higher can be your potential, reward. So we feel that the both the alpha, is available in the mid and small cap space, and also the Indian markets is so amazing that you have more than 3, 4 thousand companies at your disposal. And now with the last couple of years, so many IPOs have come and so many more are lined up. I mean, the choice is just unbelievable, right? Now, so you there is so many options for you to pick from to outperform, right? Because end of the day, right? If you have, let's say, 200 companies doing extremely well in a year, outperforming the index, right? All you have to do is pick 25, 30 out of them, out of those 200, right? Which is something which still ends up being difficult, but at least you have that kind of universe to operate in, right? That is number two. And finally, I think the mid and small cap, for smaller players like us, right? Because we can be very quick, right? And relatively, we can build a position much faster than an institution, right? That is also a source of alpha. right? Because let's say a company comes out with extremely good, earnings, right? Then I can build my position in a matter of, a few days. But if an institution wants a piece of that action, then they will take a month, 2 months to build that position, and their buying itself will give me that incremental, 20, 25% pop, right? Which gives me a lot of cushion if you get it right, obviously, right? So I think these are the two, three main reasons why we, stay in this particular universe. And why look at the, 6 to 8 or 6 to 12 quarters, because whatever study I have done in terms of, multi-baggers or, perform stocks which perform very well, right? Typically, you will see that the average duration of hold will be that number of, 8 to 12 quarters, right? Between 8 to 12 quarters, most of the move for, I think, 80% of the multi-baggers would play out. After that, they would go into long consolidations, and maybe if they are multi-cycle plays, then you will have one more leg. But generally, from the bottom to the top, that period will be about 6 to 8 quarters, or at the max 12 quarters, right? And generally, this move starts with a catalyst, and typically that catalyst is the earnings, right? So if a company starts growing significantly faster than what it has been growing earlier because of some catalyst in that sector, in that industry, then you will see that, and if that catalyst is sustainable, if that catalyst can power the earnings for the next several quarters, then you will see that the stock will get re-rated. So that is the core thesis on which we operate. And the best part is this kind of a window where a company performs for a period of 6 to 8 quarters can be found in almost every company, right? Right? You will, let's say if you have a 5 year hold or a 3 year hold, then very few companies will give you, an opportunity whereby the stocks are doing extremely well for that period of time. But a 6 to 8 quarter kind of a window, you will see in the life of many companies several times over. So again, that increases your, size of, the opportunities. So I think these are the different factors why we've kind of zeroed in on that strategy. And finally, like I said, everything is driven by earnings and perception of earnings. This is an edge that is not going away because it is a structural edge, right? It is not like an arbitrage that can be closed, right? It is structural to markets. Earnings is what drives market, or the perception of earnings at times. Sometimes the earnings may not come, but the perception of earnings, if it is there. So, so that's a structural edge which we try to, capture, and we've built that into our system, and that is how we've been managing money for the last several years.
Sure, no, yeah, I can relate because whenever I've spoken to some of my family, close family relatives, what they do is they tend to do large cap by themselves because they feel that it's safer to take those decisions versus small cap and mid cap, they tend to invest in funds, which I feel that when you are doing large cap by yourself, there's only so, like getting alpha on large caps is very difficult, right? Simply because almost all the information is already out there per se, versus let's say when you're comparing it with a small cap where not so many analysts are tracking it, and then we to go next level. Like there's a running joke between us where we say that large cap, mid cap, small cap, and then comes micro cap, then comes nano cap, then
Yes,
comes kachra cap. Kachra cap is where we tend to invest
absolutely.
in, wherein we try and find a diamond out of those so many companies. Like SME, there were some 250 SMEs which got listed last year. So if you just look at the sheer like 200 days, 250 companies, so literally have 1.25 company every day hitting the markets, right? And probably you'll
Absolutely.
get like 6 to 8 of them which will do well in a year. So it's just very important to be there. But yeah, my question to you is, are you sector agnostic or how do you look at sector as well? And like you mentioned that sector should have some earnings surprise. But other than that, is it every sector that you will work in, or are there some restrictions? How do you look at sectors per se?
In terms of restrictions, there are no restrictions, right? So we've made money in PSUs, made and lost, let me say. It's not always only made, right? So whether it is PSUs or whether it is, commodities, whether it is cyclicals, whether it is secular growth. So I don't think, I come with an open mind. I don't have any restrictions. I let the results of that season drive me towards the opportunities, right? So that is again, how I try to remove the biases. So that is why being data driven helps you over the long term, it helps you at the portfolio level. Individually, you can have a brainwave and you can have some idea where you will do well. But over the long term, if you're thinking about this game for 20, 30, 40 years, then you have to have a system. You have to have, a mechanism whereby consistently, if you do something, you have to have an edge, right? That is the game at the end of the day. Right? Especially when you're managing public money and even for your own personal money, right? You have to have an edge. You cannot depend on some stroke of luck or some stroke of genius, right? So we are very much driven by the earnings. We are very much driven by the news catalysts, which drive the earnings, not random news catalysts. So in that sense, we are open to all the sectors, but we try to, because the end of the day, in any given quarter, in any given time frame, you may have 100 different opportunities. Now, you cannot own all the 100. So there has to be a way to filter. So that is where your sense of the sectors or the themes or the filtration comes, right? So you have to figure out which of these themes or sectors are under-owned, which of these themes or sectors have are likely to have the fastest earnings growth, which of these sectors are institutional quality sectors. Because at the end of the day, in a way, we are trying to front run the institutions, right? A smaller players like us, right? So you have to also think, one of the angles is that which of these sectors are likely to be bought by the institutions, right? In that sense, you do the filtration and then you come out with, 4 or 5 or 5 or 6 themes which are working and which are likely to work over the next 6 to 8 quarters and build a portfolio which consists of those 5 or 6 themes out of, let's say, 10 or 12 themes that have come out from the result season.
Got it. And how do you look at valuations? Like, just to take a sector, aerospace is super hot right now simply because there are structural tailwinds, which the industry is getting more and more work is getting moved from US to here. But the valuations are pretty wacky, right? Like when you just look at it from a high level. So how do you look at valuations? Do you feel like, and if you have like, do you think that probably joining a tailwind sector late is also okay, or do you feel that if you have missed the bus, you have missed the bus and you look at something else later?
Yeah, I think this is where I differ, from a lot of traditional investors, right? So, see, valuation is not an absolute concept, right? A lot of people say that 70 ka PE hai, so it's expensive, but I don't subscribe to that notion. And from experience, right? It's not something, so you have to ask yourself, why is the market assigning this a 60 or a 70 or a 80 PE, right? So generally, you will see there'll be two reasons, right? One is the company is very small in market cap, so and it is operating in a sector where the addressable market is very large. So there is a potential for this company to do extremely well, right? So the growth is very high, right? In a segment where the addressable market size is very large. So that is why you're getting that 70 PE. So if the thesis is right, then that 70 PE in a matter of 1 year can become a 30 PE. Right? If the growth is the bottom line can grow by 100%, right? Which just takes, let's say a top line grows at 35% and you have some margin expansion, your bottom line will grow at 90-100%. So looking at the trailing PE and coming up with valuation is a futile exercise, number one, right? The second reason why companies have a high PE is because of predictability of growth, right? This is what you see in the FMCGs and the MNCs of the world, right? Because even if the growth is 10%, you can pencil in that growth for 20 years. At least the market tries to pencil that, and that is how you get when you discount it back, you get the high PE, right? So PE should always be seen, it's an equation. So we are seeing only one side of the equation. We should also be willing to see what is the other side of the equation that the market is seeing, right? And then try to make sense of it. It may so happen that it is not making sense to you. Now, SpaceX is a great example of that, right? Makes no sense to many people, but it may turn out that it did make sense,
Yeah.
right? We don't know 10 years down the line, right? 5 years down the line, we don't know. At that point in time, the market cap may be higher than what it is today, right? So, and there has been studies, around this, right? I think it was Professor Sanjay Bakshi who published this study, which was done in the US. I think he put it on his blog somewhere of how Coca-Cola or Nestle, I think one of these companies, right? Even though the starting P's were extremely high, when you looked at it 10 years later or 20 years later, those P's, people still made money with those high starting P's, right? So P or valuation that people, typically talk about, right? It should not be looked at in absolute terms. it has to be looked at, in terms of why is that company trading at that valuation. So if you come to aerospace now, right, obviously, the disclaimers apply, so we are not, so aerospace as a segment, right? It's a segment where there is these companies have built the right to win. It is a space with very high entry barriers. A lot of work has gone behind the scenes. So the earnings have not yet come. Right? So if anybody is evaluating it on today's earnings, right, then that is the wrong way to look at it. Right? Because the market is not looking at today's earnings. The market is saying that the earnings will come 3, 4 years down the line. So that 100 PE actually may be 30 or 40 PE when you look at it with the earnings of 2, 3 years down the line. So one has to have a sense of where the earnings of this company can go, and only then can you make a judgment on valuation. Cannot make a upfront judgment on valuation कि अरे ये तो 90p है so छोड़ दो इसको. That doesn't work. And I'll tell you, if you go and study the biggest winners in any year or any 2, 3 year period, it will always be stocks with high PE. You can go back and check. And I had also published a small piece of data on Twitter, I think a few months back, that in this correction that happened, right, both the bottom quartile of P and top quartile of P both fell the same. In fact, I think the top quartile of PE fell less, right? So what are we talking about? I think people just talk about valuations in a very surface level manner. The market is not dumb, right? So market can go wrong with valuations. So you have to worry about valuations when there is a frenzy. So context is very important, right? Randomly at this point of the market, we should not worry about valuations. You should worry about valuations when the market has been going up for 2, 3 years. There is all out frenzy. And when your segment of SME is just flying all out, that is when you have to say, okay, things might be, that is when you have to, but even then, I mean, independently, then you have to worry about a market, a cycle change, right? Because the bull market has run for 2, 3 years. It's likely that we go into a pullback, consolidation, correction. But that is when you have to worry about because at that point in time, what will happen is the 100 will go to 150, right? The 40 will go to 60, right? So if you have participated from 100 to 150, because let's say aerospace you buy at 100 now, peak of the bull market it may go to 150, or it may go to on higher earnings. If it will be, so a lot of people would have made multi baggers. So if the stock has run up already, then you worry about valuations, but not before the earnings have come. So it's very contextual. It's not easy, and you have to look at each company, each sector individually, understand the context of that sector, and then make a judgment, and not make like a straight line judgment that screener पे PE देख लिया अरे नहीं हमको नहीं चाहिए. That doesn't work.
Yeah, no, agreed. Internally, we call this don't fight the sector. If the market is giving the sector
Absolutely.
a P, there would be a reason for doing it. Don't try
And the
and
context and where are we in the market cycle is very
yeah.
important, right? So if you are towards the fag end of the cycle where you made good money for 2, 3 years, there is all the reason to be cautious. This is a lesson that I have also learned along the way, right? There are times when you have to be cautious, and there are times, so there is no one strategy for all environments, because that is a mistake a lot of people make, right? They have one strategy and they feel that this strategy should give me money all times of the market, but the market is ever changing, right? So you have to understand the regime, the context of the market, and based on that, you have to adjust incrementally at the edges. I think that is what works over the long term.
Yeah. So would you say that you subscribe, and I'm just written a few points so I'm taking, would you say that you subscribe to buying strength and selling weakness, or like Ajay would say, વધારે વધારે લેવાનું, ઘટારે ઘટારે વેચવાનું? Would you say that you would subscribe to that? And second, when you are entering a stock, even when the valuations are stretchy, do you look at technicals at all? Like if the like SpaceX, if you take the slide is the chart is super extended, right? So if you had to take an entry, would you look at, and again, this is disclaimer, just hypothetical scenario, but let's say if you had to take an entry, would you wait for it to cool down, or would you say that, okay, in the long term, it doesn't matter if I have to enter, I'll enter irrespective of the chart?
No, I think definitely I buy strength, but I don't sell weakness. So I will sell, if the weakness is accompanied by a change in the fundamentals, right? Because if buying strength is important because see, you cannot research all the stocks in the market. So strength is like a shortcut to tell you where the action is, where the buying is, right? So it's a shorthand. It is for lazy people like us to, because we can't research all the 4,000 stocks, right? So it tells you where the market is agreeing with you. Somebody else may have done the research. So why is the stock going up? Because somebody is buying. Why is he buying? Because he thinks it will go up, right? Why does he think he goes up? Because he has done the research, right? So buying strength, and I don't buy blind strength, right? I use it as a scan. It is a scan for me to see where the activity is, where the action is. It is using the market's intelligence to your advantage. Again, very contextual. Strength at the beginning of the cycle and end of the cycle are two very
Yeah.
different things. This is a distinction I'll keep making again and again, right? So definitely I will look at strength. If you look at relative strength in the last 3 months, it has worked phenomenally well because we are at the bottom of the cycle. But relative strength and momentum towards the end of the cycle can kill you, right? So yeah, so I buy strength, but I don't sell weakness unless that weakness is accompanied by a fundamental deterioration, right? In which case, I don't bother about the fact that it is down 20% from the high, 30% from the high. I will not bother. If there's a fundamental deterioration, I am cutting my position or reducing my position or taking some action, right? That is number one. Number two is, I mean, you mentioned SpaceX. So see, SpaceX has no technical history. It's just been 3 days right now, right? So you can't. So SpaceX is something we have to see it, and we have to allow the price to find its, and I think the float right now is just about 4%. Right? And very soon, once they get added to Nasdaq in 15 20 days, the float will go to 50%, right? So it's a completely, I mean, SpaceX is a, it's a different, it's a unicorn, it's a ball game, it's a different ball game. But yeah, technicals, I use it more as a scan. I don't use technicals in the sense of indicators and all of that. I use it more as a scan to see where the opportunities are, what the market is liking, what the market is not liking. But I will generally act only if I can combine the price action with some sort of a fundamental information or a catalyst.
Understood. That's helpful. Let's say you had to give marks out of 100 to both of these, like how much of making alpha is a factor of your stock selection versus the market environment out of 100% in, let's say, a 2 year period versus a 5 year period. I know you said that cycles and cycles you can't really predict, but still, let's say if you had to, because from whatever I've seen, you can do the best you can, but if the market environment is not in your favor, you need to grind out through that cycle, right? So do you agree that in 2 years, while it may not matter and market environment will play a bigger part, versus in 5 years, things should start tilting towards your stock selection versus, let's say, a market environment? Or do you think that time period is different?
Um, no, see, again, it's very strategy specific, right? So let's say a value investor. For a value investor, a bad market environment is where he thrives, right? Of course, the returns won't come, but he will be thriving in that environment because you get value, you get what he's looking for, right? For people like me who's a growth investor, right? Growth is rewarded only during good markets, right? It is punished during bad markets, right? So for somebody like us, a good market environment will have much more weightage, much more marks versus somebody who is a pure, pure play value investor. So the context again matters. In terms of the split for a growth investor, I would say, it would probably be, 60, 70% is the market and 30% is, your stock selection. Because I'm talking about the returns, right? Because see, the 60, 70% is the beta that you get from, if the market itself is not doing well, then in an absolute sense, it's very difficult to make returns at a portfolio level, especially if you are running a fairly diversified portfolio. Because when you're managing public money, you cannot, be concentrated and have only four stocks, five stocks, and all that, right? That's very, very, very risky, and and it's not worth it also, right? So only such people can make money even during a bad market, but it's not repeatable. You're always at the edge. You are just one accident away from getting killed, right? So in general, I would say 60, 70% is the market, and the incremental that you make, the alpha that you make is always the stock selection, right? Now the amount of alpha that you make can also increase depending upon how good the market is, right? Because if the market is good, your strategy hit rate can go to 90%, 95%. If the market is bad, the strategy hit rate will fall to 50-60%. Right? In terms of the performance, in terms of the returns. Your process may be right, your stock selection may be right. So market environment plays a very big role, and that is why investors have to understand cycles and use the cycles to their advantage, right? Now the IPO guys, like your viewers, right? They have to get very active as the market environment improves, and they have to become very passive in a bad market environment, right? They have, in terms of leverage, in terms of when the going is good, because the IPO pop guys will thrive in a bull market, in an out and out bull market. So that is when they have to push the pedal, right? But with an eye that, okay, when, like in that movie, Margin Call, they talk about, right? When will the music stop, right? So you have to have a sense of when the music will stop, but you have to really push the pedal in a bull market, right? And be very passive or even stay out of the market, during the bad phases, right? So I think market environment is the thing. Market environment is the thing, and it's not that difficult. People have to focus more on playing the cycle, understanding where we are in the cycle rather than stock selection and all that. Because even if you are a mutual fund investor and you understand cycles, right, you can still beat a very good stock picker if you get the cycles right. Right.
Sure. Agreed. 100% agreed with you on fact. Just one pointer when you said that IPO guys will thrive in bull market, we have seen just the opposite of it. For a amateur, it makes sense simply because you're not doing that research versus let's say right now, there are good companies which are coming and you tend to get allotments easier or allocations easier compared to bull market simply because there's no so much frenzy. So you could ride those waves a lot more better compared to bull markets simply because there everything would get priced in the listing price versus let's say you can in the current market you can buy a lot of things on listing and then hope for some momentum which has worked at least in the last 3 months. Almost all the IPOs have opened very decent percent then have worked after that, so it is easier for IPO investors as well as long as you are not just a amateur who just completely applying or randomly looking at the premiums etc. It is actually easier to make uh, alpha over this period of time. Second thing, like you said, you're a growth investor. I remember every Reliance Industries report that you open, the first three words it says growth is life. So I can definitely relate to you, and that is how I look at it as well. Maybe going back, your views on these 2 pointers, then going back, you said that you don't really meet managements, etc. So do you think it's not risk? Is it risky, especially in India? There are always like you cannot be 100% aware of corporate governance, etc. Right? So how do you look at CG if you haven't really visited the plant? If you, especially for small caps, how do you get that confidence and are able to sleep well with big positions, especially when you haven't really seen the company or etc. things on those back?
Yeah, I think so. You answered your own question, right? So yeah, so the solution is not to have big positions, right? The solution is in a small cap, in a micro cap. You cannot have big positions because even after seeing a plant, you can still be taken for a ride. Right? There are several examples of that, and some of the the Indian promoters and all promoters are extremely smart salesmen, right? They have built their businesses, so they are 10 times smarter than us, right? They're 10 times smarter, and they are more savvy than us in terms of people skills, right? So there is a lot of inherent bias, number one, right, in meeting promoters and all that. So you tend to, if you meet a promoter, you can go overboard and go for that high allocation and be taken for a ride. Number one. Number two, it's not a scalable process, right? So we are a small team, so you have to play to your strengths, like I said earlier, right? So we can. How many managements will you meet? How much you will be traveling? You'll be traveling throughout the year, so you cannot, and I don't know how much the hit rate is versus meeting the management and not meeting. I don't know how much extra alpha you can get from meeting the management because mostly they'll be telling you only good things only, right? They will not be. And number three, we are in an environment where even the managements don't know what's going to happen 2 years, 3 years down the line, right? Everybody is equally clueless. Things are moving so fast. So I think it's more of a personal, satisfaction metric that but the most important thing is it's not scalable. The reason why we don't do it is because it's not scalable, and we are people who want to be at our desks, who want to be reading, who want to be thinking, who want to look at the market price action, and this I think gives us a very good holistic picture and the experience that we have in the markets, right? I think we get even the frauds we can kind of catch just by looking at the price action, just by looking at how they are presenting the earnings, what they are showing, what they are not showing. I'm not saying you will catch every fraud, but we are confident that given having watched so many hours of worths of thousands of hours worths of price action, plus so many hundreds of quarters of earnings results, we can figure out where it is believable, where it is not believable. Number one. Number two, like I said, we play. So we have a 25-30 stock portfolio in mid and small caps. We feel that's a fairly decent number, right? It's a midway. And by having a lower allocation, the other advantage that I keep talking about is the optionality, right? Because oftentimes you will see that the stocks which you don't think do well turn out to do the best, right? And the stocks where you have the conviction will actually may not be the best performer. They may still do okay because the stocks where you have conviction, what you are seeing, 100 other people also are seeing, right? We are not geniuses, right? So it is the stocks where the conviction is not there because there is some variable that is missing there. And if that variable falls into place, that stock gives you the biggest alpha. So if you are a concentrated investor, you will try to tend towards the conviction names only. And anything where one or two things are off, you will just leave it. But those one or two things off is where the edge is. Because if those one or two things fall into place, it's an
Yeah.
unexpected surprise for the markets. And those, so as a diversified investor, you get to play those also. You can disregard, one or two bad things, still participate if the growth is there, if the theme is intact, and actually make more money than a concentrated investor with more predictability and less risk. So that's how we think about the whole allocation process.
Got it. No, I am super jealous of you. Like in the last month, I have traveled to Rajkot, to Indore, to Hyderabad, simply because my job is like, especially because we are just starting, right? So, and we tend to work a lot with primary markets, especially with very small size companies, right? So you tend to really need to go and visit and understand the story. So I wish I could just sit. But yeah, that's like if I
No,
have
no,
to
it's
think
not
about
like
it
that.
in the
See,
longer term,
I
uh,
don't know if you've read the book Trading in the Zone, right? So it is one of the very good books on market psychology, right? So in that book, he compares markets to a river, right? There are different ways you can utilize
yeah,
the water of the river, right?
yeah,
You can drink water, you can haul the water out for irrigation, you can do 100 different things, right? You can go boating into it, right? So there are many ways to make money in the market. So you have a way, we have our own way. It's important to be true to what you are doing. Now your edge is meeting the or part of the job is meeting the the primary bankers or whatever, right? So you cannot hope to do what I'm doing. I cannot hope to do what you are doing. Right
yeah,
now, if I want to get into, see, why didn't we get into SME? We have all the knowledge, the wherewithal, for the same reason that SME is a game where you have to have feet on the street. It is a game where you have to be close to the management, where you have to have a sense of what is, because the frauds are much more there,
yeah.
right? So you have to have a sense, you have physical presence is important. And we are not geared up for that. That is why we know our strength and we know our weakness. It is very important in the markets, right? So you have to, once you know your weakness, you have to let go. You should not play that game, right? So what you're doing is also not wrong. What you're doing is what you need to do, and what you guys love to do, and that is the space that you love. And we are doing, what we are aligned to do. I think that's what it is about.
Yeah, but I agree with you on the scalability part. Like there is only so much you can do. Right now, we are really enjoying it, but probably over the future, we want to consciously shift a bit towards being able to build positions from secondary. So definitely look forward to learning from you on that part. And like you said, when you have a diversified portfolio, it's a lot like risk is a lot more lesser. And like Charlie Munger says, all I want to do is know where I
Yeah,
die so that I never go there per se. But yeah.
absolutely.
Definitely agree with you on part. I had one specific question from you because I was hearing your podcast. You mentioned under ownership as a catalyst at a lot of places per se. So, how do you identify under ownership, etc.? Like, how do you look at a stock and feel that this is, and like, what all are the parameters that you typically look at?
No, it's basically either a stock that is neglected or a stock that is new. Right? Like I said, at IPO, right? The whole game is under ownership. IPO is something new. Other than the promoter, a very few guys have, the stake and the company comes into the market. So it is a company which actually turns out to be a good company. And then a lot of people would want to own that company, right? and that is what gives you a persistent demand, a persistent buying demand, and the supply is limited, right? Which is the whole thesis of why a good IPO works so well, right? Similarly, in other stocks, already listed stocks, right, you will see that certain stocks and sectors, because the earnings growth has plateaued or there is nothing happening in that sector, stocks will go into 3 years of going nowhere or going into a downtrend and consolidating. So that is again neglect. That is again everybody who wanted to get out would have gotten frustrated and gotten out. So anything more than 2 3 years old which has gone nowhere, and then a new catalyst comes into play, right? That is qualified as a neglected stock, or that is that which is a likely under-owned stock, right? So if you look at stocks like HFCL and Sterlite, right, they were neglected and under-owned for many because they were like corporate governance is not good, nobody is bothered, right? And the stocks were doing nothing. They were doing commodity business. Suddenly, this whole AI thing came in, and a catalyst came in, and look at the way they got re-rated because they were under-owned, and everybody wanted a piece of the action, right? So the same if the stock is over-owned, right, which is what happens towards the end of the bull market. So when you have over-ownership, everybody who had to own the stock has already owned it. A good example of this probably is Nvidia, right? Just yesterday, I was reading that some family office fired their entire global desk or something because they did not invest in these, top five names, and very recently they, reluctantly got into Nvidia. Now, so it's like Nvidia is there in every global portfolio. Nvidia is there with almost everybody. I'm not saying that Nvidia, but what I mean is it's more likely that Nvidia underperforms because it's over-owned, right? Unless that over-ownership, kind of is, unwound, right? It will. So that's the concept. It's a very important concept to understand how prices move, how fast they move, and how slow they move when they consolidate. So if you have a catalyst meeting under ownership, you can have a very rapid move. And if you have a catalyst meeting and over ownership, you can even with good, numbers, the stock may still not move. So it's not all about fundamentals. It's also about understanding how the stock is positioned with respect to ownership. That is what I mean when I talk about
Understood. Perfect. That's helpful. Maybe moving forward to the next section, and we are also running slightly behind on time, so I'll be slightly faster. But how do you look at booking profits? And again, from whatever I have heard, entering is a lot more easier than exiting. So how do you look at taking the exit? And a sub question to this, do you look at tax optimization, or do you just completely ignore it out of calculations, LTCG versus LTCG, or versus STCG? How do you look at that?
it. Cover the tax part first because that's the easier and simple answer. So there is no tax optimization that we do because it's just cost of doing business, right? It's a noise. You should not bother about it. Because see, you cannot see. You have to always think about it from a long-term point of view, scalable point of view. Of course, if you have a tax loss booking opportunity, you do those things. It is not that if money is on the table, you don't take it, but you don't change your strategy based on trying to optimize tax. You do not sacrifice tax loss booking versus being invested in a stock or such things. So. Whatever is possible to the extent that it doesn't damages the thesis, we do it, right? But at the same time, it is not a consideration, right? So that is one. And what was your earlier question?
So, my question was, how do you book profits? How do you look at
Yeah, yeah.
exiting person?
Yeah, so see, like you said, right, that's the common thing that buying is easy, selling is difficult. So I've thought a lot about this. So I think the way to handle selling, right, is because selling is all about regret, right? Either you sell too early or you sell too late. So the way to handle selling is to make it an incremental approach, make it incremental. Because like I said, it all comes back to a mind game, right? Because the market is playing with your mind, right? So how do you defeat the market's mind games is by taking an incremental approach, right? So it is like so I have different events, right, whereby I will look at selling. So if a stock is going into a euphoric run, I will incrementally reduce. If a stock, has a bad quarter, I generally give stock a couple of quarters, right? So if a stock has had a bad quarter and I feel that the train is slowing down or, the story is not as good as I expected, I will trim, right? If there is a sectoral event which impacts the company, I will trim. So I will keep trimming like this and keep bringing my allocation down so that even if, because a lot of times what will happen is it will be a temporary issue and the stock will bounce right back and hit a new high. So if you have trimmed, then you're still in the game. Psychologically, you're okay. कि ठीक है थोड़ा सा मैंने कर दिया, but I still have the rest of the position. So that is how you manage selling. You make it an incremental approach. You make it an incremental affair. Because if you do make it an all or none, then more often than not you'll be filled with regret. You'll make mistakes. You will jump and buy again if it goes. So you will do all sorts of mistakes. So I make it a very incremental approach. I have a list of events defined which will make you reduce your position. Right. Of course, if there is a fraud or if there is a extremely bad earnings, and I know that this stock is the story is over. Of course, at a one shot, I will get out. But if it is a smaller issue, if it is a temporary issue, if I find some other better idea and I'm not very convinced about this, I may reduce this. So I take incremental reductions over a period of time, which psychologically, helps me exit a position. Right. So even if I'm in a loss, let's say in a particular stock, a lot of people can't book the loss because psychologically it's painful. So the way to handle it is don't book everything, book something. That will ease you into the process. Once you start acting, right? Once you book something, even if the stock falls, you mitigated your risk, you reduced your allocation. Right? You'll be in a much better frame of mind to take decisions.
Yeah.
Right. So I would say make it an incremental approach. That has really worked for me for selling. Not
Yep.
for buying though. Buying is one shot.
Got it, got it. And in fact, like I have seen a few Ashwat Damodaran valuation videos, almost all end with the same thing that book half, keep half, probably because then the stock goes either direction, you are just not completely miss the boat. You have
Yeah,
either sold some, yeah,
it's a
or
psychological trick. I take it one notch higher. I don't do half, but I might
yeah,
do like I have like 3 or 4 increments generally. So I might. So in some cases it may be half, in some cases it may be full also. But I'm saying the thought process is that take an incremental approach. When in doubt, reduce.
got it.
It helps you, it helps you mitigate even because you may go wrong. A lot of times we sell out of fear, right? And the stock bounces right back, right? Because so if you take an incremental approach, either way you'll be psychologically okay.
Got it. And how much of like portfolio management are you actively doing? Are you always tracking your 20 companies? You are the one who are taking decisions end of the day, or is it also like a team involved which you are able to sublet a lot of your decisions to?
No, so we have different products, right? So the entire PMS, the entire equities part, right, that I manage completely. So so all three of us are the final judges, right? At the end of the day, individually, so we have PMS, we have AIF, we have an advisory product. So individually each one of us is responsible. So I'm responsible for PMS, Atul is responsible for AIF, and my other partner Shivaram is responsible for the advisory piece, right? But the overarching philosophy of earnings catalyst, and that philosophy is a combined philosophy.
Mm.
But the final stock selection that happens individually at each product level is an individual decision.
Understood. Maybe without naming a stock, can you give me which stock did you hold for the longest period of time? What was the thesis? Did it work or not? And similarly, which was the stock which gave you the best return? How long was the holding period, etc., in your career? Or if because it's past, you can also name the stock if that's okay. Yeah.
With many winners. So, I mean, more recently, I think all the defense names, a lot of power names, when a lot of the power names are doing extremely well right now. So we've been holding them from the previous cycle. A lot of defense names we've been holding them. We might have trimmed, a few after that, election disaster that happened, and then we might have added them back and all that. But we've been owning the defense, the power names for a long time. We owned Bajaj Finance for a long time. We've owned. I mean, now we don't own it, but that was one of the stocks in the earlier part of the journey. Like I said, Page Industries, Hawkins. So some of these have been like long-term holdings, but I would say the average holding period again will come down to that same 3 4 years, right? So about 12 quarters is about 3 years. So average will come to most of the cream, right? Most of the malai is had in the first 3 years, right? After that, it goes into a consolidation for 1.5 years, and then you may have one more cycle, right? So
Got
yeah.
it. Got it, understood. And then, like, how have you handled the current war situation? Is this something which you have done different? Similarly, with all the FII selling, are you doing something different? Are you looking at the market something differently?
See, I think for somebody like us, right? Because the advantage, especially in an environment like this or any market, is that we are active investors, right? We are active in the sense that, like I said, right, we don't have any fixed notions that I will invest only in this sector and I will sit here for 3 years, 5 years. We are okay to align with the market as the environment changes. So, in that sense, that has been a source of strength for us, although the drawdowns were very deep in the last couple of years because of the space that we operate in. So that is what I continuously used to tell my investors, that see, we are in the mid and small cap space and this is to be expected, because the 2 3 years before that we did phenomenally well, right? So now the problem is the investors who came exactly 1.5 years back, right? But even them, we would have told them, right, that this is a 3 to 5 year game at least, right? So you have to play the cycle. If you come at the top of the cycle, right, because top of the cycle is only known in hindsight, right? So if you come at the top of the cycle, then it is a painful period, but the market will make up for it. It has always happened, right? So the people who are with us for 5 6 7 8 years are all, they were all happy. But the people who have come, let's say 1.5 years back, they were a bit distressed because of the kind of drawdowns that happened. But in a matter of, like, let's say a few weeks, the story has changed, right? So I think one of the biggest things that we have done is we've stuck to the strategy. We have not panicked and in the throes of the correction changed and moved to large caps or go into safety. See, if you are prone to doing all that, then the market will kill you, right? So you have to be consistent, right? Because the market is anyway fluctuating. If you also fluctuate with it, then you'll go for a ride. It'll be like a yeah, you are in Disneyland, right? So you have to be consistent. Let the market fluctuate. You both can't fluctuate together, right? So that's a part which investors miss, right? So in that sense, the thing that we did, the way we managed it, is we stuck true to our strategy. We did churn the portfolio. We got into sectors where the growth was better. We got out of areas, but we stayed fully invested. We never tried to game the market. We were willing to be patient for as long as it takes, right? And that is why we were fully invested at the bottom, and we were able to brilliantly ride the up move that came in the last 2 months, right? So we've done phenomenally well in the last 2 3 months because we took the pain earlier,
Yeah.
right? So in that sense, I think two things, right? One, being active allowed us to get into the right sectors, and number two, because we are focused on earnings, right? Even before the prices moved, we were able to reorient the portfolios correctly, right? So the sectors where the growth was there, we were able to reorient correctly because we don't wait for price action. Like I said, right, price action is just a scam for us. In a bear market, you don't get any price action, right? So because of our earnings, alignment, we got into the right sectors. We stuck to the strategy. We took the pain, and looks like we are being rewarded so far.
Yeah, no, last 2 months have been very good for mid cap, especially. Mid cap is almost like index is almost touching all-time high. Um, and this is a question which you'll probably have gotten a lot. What sectors are you the most bullish on right now? How are you looking at the markets from there?
Yeah, I think again, more we are more data based, and this may change next quarter or 2 quarters down the line. But right now, it looks like where the growth is. Obviously, the whole power and power ancillaries, right? Auto and auto ancillaries. The whole CDMO pack is one area. Like defense is one pack. The whole AI ancillaries, which are supplying to the global markets, right? Textile can be a dark horse because of the FTAs, and they've gone through a very bad patch. The numbers, are likely to improve going forward, right? I think a lot of stocks which were hit by tariffs, right, which in spite of the tariffs did exceptionally well, right? They were able to mitigate such a bad environment, right? Just
Yeah.
imagine how they will do once now that tariffs are gone, right? So that is one theme that is worth tracking. Of course, stuff like aerospace that you spoke about. So I think there are a lot of pockets in this market where there is good growth over the next 2 3 years. The only thing that I will point out is that uh, the top 50 companies is not where the action is. and which is I think very clearly the market also is telling everybody, because if you break down the top 50 companies, right? So you have IT, the large cap IT is in a mess. There's a lot of uncertainty. The mid cap IT is still doing well, and that is also an opportunity I feel, because they are nimble, they are AI first, and they are doing all the right things. Some of them have done very good acquisitions, right? But large cap IT is in trouble. Consumption is growing single digit. Private banks and PSU banks are doing okay, nothing great, right? So the Nifty 50 or the Sensex is not where the action is. The action has shifted to the broader market and the other sectors, right? And that is where the investors have to focus over the next 2, 3 years.
Perfect. And maybe towards the closing of this podcast, a couple of questions. What's next for Samvitti? Have you ever thought about probably going public, and why or why not? How do you look at that?
Think like I said in the beginning, right? We never had a plan 10 years back, and we just enjoy this game and we want to do it forever. And this is a game, which you can play like Buffett is showing us, right, into your 90s. So I hope to be able to do that. And let's see where the company takes you. Like I said, right, in our business, there are only two variables, compliance and performance. Be strict on your compliance, be on the right side of the regulator, do the right things, and perform. Money will come, right? And most importantly, see, it's very easy. A lot of people have told us, right? Especially 1 or 2 years back when you were hitting the top of all the charts in terms of performance and all that. That if I was running your company, my AUM would have been 10,000 crores, right? Which I know, because if we tie up with a distributor, and if I start going on the road and meeting people and all that, say be more salesy, but that's not inherently what we want to do. That is not why we set up this company. We set up this company because we enjoy this game, right? So I'm okay with the 2,000 versus 10,000 also, right? And so let's see where it takes us. I think markets are very unpredictable, right? And we are in the business of markets, so inherently our business also is very unpredictable.
Yeah.
But I think one thing is for sure, we will continue to do what we are doing, irrespective of where the AUM goes.
No, yeah, you enjoy the game, right? So it's about playing the game and being able to play that game every day. So yeah, one message that you would want to leave us with an average IPO investor who's watching the show, and then one message which you would want to leave me with, knowing my journey as such.
Yeah, I think specifically for an IPO investor, I mean, see, there is no thing called as an IPO investor. I think we are all investors, right? So, like you said in the beginning of our discussion, that IPO is where people generally start. It is
Yeah.
the start of the journey, right? But I think, see, IPOs, if you only want to focus on IPOs, right? Like I said, IPOs are very, very lucrative because of multiple reasons that we discussed, right? One is a lot of new companies, new categories, low float, multiple things, right? So people have to obviously learn to research, right? People have to learn to understand, differentiate between the frauds and the real companies. But I think the main thing is to identify themes. If you want to be a successful investor, whether it's IPO or secondary markets, right, you have to have a sense of which theme is working right now and which theme is likely to work for the foreseeable future, and you have to bet your money around those themes. Now, if you put money into some random aquaculture IPO right now, and I'm just giving a random example, versus let's say a power or a semiconductor IPO, there's a world of difference in terms of how both the IPOs will react, how they will pop, and how they will do after that, right? So I think the basics don't change, but building this capability to identify themes and making your investing more thematic can really turbocharge your returns. I think that would be my message to any investor, and specifically the IPO investors. But I should go beyond IPO also, because as you scale up, as that is where there is very big opportunity in the rest of the market also. You're confining yourself to a very small section of the market. Secondary market is 10, 15, 20 times bigger, or maybe 100 times bigger than the IPO space, right? So there's a big opportunity out there. So people have to explore that also in the second phase once they master the IPO. As far as you, I think you're doing exceptionally well. I cannot give you any advice. You are doing the right things. But I would say, yeah. So, like I said, right, focus. You have to play to your strengths, right? So you have to identify what are your strengths. Sitting in Bhopal, what are your strengths as a small team? What are your strengths in terms of the experience that you built so many years, in the SME space? So you have to play to your strengths, and that differentiation itself is your competitive advantage and your moat, right? Because even with us, right, the kind of portfolios we build in PMS, you will not see that kind of a portfolio in any other PMS. Most of the PMS will have that standard set of names. There will be some overlap, but the kind of portfolios we built, our own investors tell us, right, कि companies का नाम ही नहीं सुना है हम लोगों ने. The typical investors, not the market people
Yeah.
who are involved in the markets, but so a lot of new companies. So I think so. You have to focus on where your strengths are, and I think you should slowly graduate because SME, micro cap, like you said, right, small cap, they are all very very similar. So since you built the skill sets in SMEs, you can graduate to micro cap, small cap. There's going to be huge appetite, and the universe has exploded. The opportunity set has exploded. So you should maybe launch something where, because SME, right, a lot of sophisticated investors will put only the risk money there.
Yeah.
उसके पास 100 रुपए रहेगा तो वो शायद 5 रुपए डालेगा या 10 rupees डालेगा in your fund, right? But if you, let's say, graduate to a small cap also, right, then you can attract maybe 2 or 3 times the money. Plus, you with obviously lower risk than SME, right? Even in SME, like you said, you'll also be very extra careful, right? So I think the natural path for you to be to go up the market cap curve and follow your process, which you anyway are doing.
Perfect. No, yeah. Thank you so much, Prabhakar, for talking to us today. I'll just caveat that there are a couple of videos on your YouTube channel as well, right? Where you have walked us through the process of how to look at investing. Maybe I'll link them in the description as well. So if there's somebody who wants to understand and listen to Prabhakar more, you can YouTube. There are a lot of podcasts available, but other than that, there are a few videos which are pretty good on Prabhakar's YouTube channel as well. So I'll kind of post them here. But yeah, thank you so much, Prabhakar, for talking to us. It was a pleasure to host you in our inaugural series, and we hope we can continue to do this and probably have you again sometime.
Thank you, Manish. Thank you. It was a pleasure talking to you.